China has once again cut interest rates. This is a growing trend over 6 years after the bottom of the financial crisis. An economy which has been overstimulated and needs to rest has been injected with massive quantities of steroids to keep it going. No country, whether the US, whether China, cannot stand on its own at this time. A global economic collapse destroys all nations, and this is quite apparent right now. You came here for the truth, so let me unveil that for you. Let's get into what has happened with China. As we can see, they're using the same policies as other countries around the world. Many people believe that China is somehow impervious to all of the actions of the rest of the world. The European Central Bank, the Bank of Japan, the US, and so forth are all engaging in some sort of stimulus measures. China is no different. Let's look at this. Out of the Telegraph, China faces a significant slowdown at the end of the year, official figures suggested on Saturday, raising new fears about a knock-on effect that could hit global commodity prices and damage the British industry. So remember that obviously China being a very big supporter of commodities, purchasing a lot, and US is no different. If their economy is hurting, commodity prices will also hurt. The country's manufacturing sector unexpectedly declined for the third consecutive month in October, while the services sector grew at the slowest pace since 2008's financial crisis. Remember, this is yet another indicator that we're headed back into the financial crisis, what I call financial crisis part 2. How many times have you heard me, like a broken record, say this is another indicator? Well, I'll just keep adding them up because there are a few out there who aren't convinced yet. What I wanted to mention from this is that they say it unexpectedly declined. Well, I don't know who they're listening to, but if they were listening to the Money GPS, if they were listening to the actual data, well, then they would know the truth here. The figure suggests that China should miss roughly the rough 7% growth target set by Beijing. And all of these numbers are all very silly. I've talked about it before, how it's all about expectations. The number could be significantly lower. As long as it meets that expectation, somehow everything is fine. Let's move on to this out of the AFP. China on Monday raised the daily reference rate for its yuan currency by the largest margin in a decade, just 3 months after a surprise devaluation sent shockwaves through the global markets. China is making big changes here. They are bringing some things up, some things down. Look at this. The Central People's Bank of China adjusted the central rate of the yuan, known as the renminbi, upwards by 0.5% against the dollar. The increase is actually the largest since 2005, when Beijing unpegged the yuan from the dollar. So big moves happening right here with China, and I'd like to directly move in to what this article here, again out of the AFP. Asian stock markets Monday welcomed China's latest interest rate cut ahead of this week's policy meeting. Analysts warned that the move indicates further weakness in the world's number 2 economy. I have indicated this myself as well, that anytime you have an interest rate cut, it's because the economy needs it. They usually raise interest rates when the market's getting too hot. Obviously, they're not worried about that. But it's not just China that's doing this. Look at this all around the world. Very few have increased interest rates. In fact, we've seen them go negative more often. With Friday's move, the 6th reduction since November. They continuously are doing this every couple months. Realized hopes for further monetary easing. See, they want to not have the economy do well necessarily. They want to have the markets react positively to monetary stimulus or fiscal stimulus. Look, we'll get people to work, we'll print money, we'll do whatever it takes to make the stock market rise. It's all about making the stock market rise, not about actually getting people jobs so that the stock market naturally rises. That's not the case. Emerging market currencies also retreated as the latest announcement led to concerns about the Chinese outlook. A week after official data showed the economy expanded in the third quarter at its slowest pace for 6 years. So what I need to stress here is that the economy, according to the government statistics, is still growing, but it's growing at a slower pace than what we're used to. This presents a big problem here. I wanted to also note something in the right hand side. Asia markets rally as Fed rate rise seen delayed. So if you're going to increase interest rates, stock markets are going to go down. If you're going to delay that interest rate rise from the Federal Reserve, well then the stock market's going to go up. But the Federal Reserve hasn't done anything. Yet the market moves up and down based on speculation of these decisions. So they can have such an effect on everything that happens, not even by saying anything. It's amazing. Now, what I wanted to talk about was interest rates. In my book, I have a chapter on the 1990s. What I said was here. The last decade of the 20th century was a time of maximum prosperity. The stock market boomed thoroughly and almost continuously for the entire time, other than a few dips. And a book that I constantly recommend is The Infectious Greed by Frank Partnoy. And he said this: the 1990s is a decade of persistently rising markets, 10 solid years of economic expansion with investors pouring record amounts into stocks and pocketing double-digit returns year after year. What do you think is happening today? The investors are looking for a place to dump their money when the real investors pull out. The central banks make their way in. But the fact remains is that there was a very similar reason, was that interest rates became progressively lower and lower, and that stimulates the economy. No different to what's happening today. The Dow pushed back into positive territory for 2015 on Monday, lifted by a technical bounce in petroleum shares and data showing a 7-year peak in U.S. construction spending. What we have here is no more than volatility that we've been seeing. It's been going up and down, and the stock market, for the most part, hasn't risen since QE3 ended. It is fluctuating up and down, but if you really look at it, especially when you factor in inflation, the stock market hasn't risen since the QE3. So let me tell you that if you want the stock market to rise, just print some more money. When we see more money printing occurring, we will see the Fed's balance sheet expand. We will see the stock market rising. These are all interconnected. Let's move on to this. Sales of organic and natural products are soaring, but you would never know it from the share price of Whole Foods Market, the premier purveyor of such merchandise. Check this out, a 50% lower for the shares than they were in February, the high point of the year. Now, what's going on here? Obviously, more people are buying this organic produce, natural produce, yet they're doing bad. You would think even that the stores may be doing good themselves, because there's a disconnect. No longer are people necessarily investing in shares of stores in different companies. The investment is taking place at the corporate level, where we have corporations or central banks buying up the shares. We have stock buybacks occurring. These are what's happening to basically allow certain stocks to keep the overall stock market up to a particular level that they've decided. This is how you need to really look at it much more deeply than what we've seen. The stock market isn't rising because of individual investors, that's for sure. Now let's take a trip back down memory lane as we look at the tech bubble. A decade and a half after the fall of Silicon Valley, a tech resurrection has conjured fears of another bubble. Right here, the Wall Street just suffered its worst quarter in 4 years, and many tech companies' stocks have failed to live up to their IPO prices. And it basically goes on to say, look, there's a lot of hype, and this is bad news. But then they go on further in the article, this is out of MarketWatch, to say that, you know what? No need to worry. Everything is just fine. Why would you worry about anything here? Because, look, tech companies are important, therefore everything is okay. This is literally what they say. They talk to people as if they're babies. They use a very opinionated example and have that be the result of their articles. But you know what? It's actually working excellent because this propaganda spreads throughout the system, and I end up hearing it through the grapevine. Quite sad. Let's move on to this last one for the day. Debt ceiling lifted, and the same day debt jumps 339 billion. Oh, what a coincidence here. So we had this issue where the debt didn't move an inch for the longest time, months and months. And all of a sudden, the U.S. national debt jumped $339 billion on Monday. The same day, Emperor Obama signed into law legislation suspending the debt ceiling. Oh, what a coincidence. What a joke this is. If you found this video informative, please give me a thumbs up. Last but not least, if you found the video informative, you'll definitely find my book, The Money GPS, even more informative. If you go over to Amazon, they have this look inside feature, which allows you to flip through the pages of the book and see if you like it. Take care.